Do you want to invest like Warren Buffett or Charlie Munger or Benjamin Graham? If you do, it's important to understand margin of safety. Hey guys, this is Kevin Burgess. I finished reading a book that was a summary of a book that was originally written by a guy named Seth Klarman, I think back in the 1980s. But Paul Jones put together a summary of that book. The name of that book is called Margin of Safety. So if you want to invest like Warren Buffett, you won't want to miss this video. Hey guys, Kevin Burgess back again with another video. This book has been really insightful, and I want to share with you highlights of what I learned from this book. I know it helped me, and I'm confident that it will help you as well. The title of the book was called Margin of Safety. We're going to talk about definitions for all of this stuff as we go through, but margin of safety is a key concept in an investing style called value investing. Let's take a look at that in more depth. Now, value investing, as you see on the screen, focuses on identifying investments that are trading below their intrinsic value. Every stock has an intrinsic value. We really don't know what that is because we don't have perfect vision for the next 50 years on how a stock's going to perform and how a company's going to perform, but there is an intrinsic value for every company, and we do our best to calculate what that is. So if we can find companies that are trading on the stock market below their intrinsic value, the difference is considered the margin of safety, and therefore it's considered a value investment. We're getting more value than we're paying for it, so that's why it's called value investing. So what are some of the value investing principles? Well, value investors focus on absolute performance rather than relative performance. They don't use benchmarks. So what does this mean? Value investors tend to be risk averse. They don't want to lose their principal, and therefore their benchmark is whether or not they made money. It is not whether they beat the S&P 500 or whether they beat the NASDAQ. It is about whether or not they made money. So value investors don't benchmark against the indices. They simply look at whether or not they made money. Another principle of value investing is independent thinking. It is important that we rely on our own due diligence when making investment decisions. It's important for us in our due diligence to determine what our intrinsic value is for the company. And if you're looking to get a margin of safety, it's important that we know what that number is. The third principle is that they pay particular attention to risk. They prioritize the preservation of capital. They are risk averse. The fourth principle is that they have a long-term orientation. This requires patience for the compounding to work. If they have an investment in a company and it is trading well below its intrinsic value, there's usually a reason for that. It's seen some bad days. It is, there's something that's gone on with the company. There's been maybe some fraud. There's something that is causing that stock to trade below its intrinsic value. And as a value investor, you go and invest in that and you're looking for that return to come back, but it could take a while. So it's important that you have patience as a value investor. Lastly, diversification is a key risk management tool for the value investor. Now, diversification just means that there are multiple stocks in the portfolio. A value investor can accomplish this by buying an ETF or, something along those lines. An ETF would have multiple stocks within it, and it creates a natural diversification. But it is important for value investors that they don't put all of their eggs in one basket. So what is margin of safety? Margin of safety is a risk management tool that protects investors from the risk of losses while investing. Market price less intrinsic value is the margin of safety. So whatever the price is for the stock on the stock market, if you take that minus its intrinsic value, you should get a negative number if there is a margin of safety. But here's a key point at the bottom of this slide. Value investing requires a great deal of hard work, unusually strict discipline, and a long-term investment horizon. few are willing and able to devote sufficient time. So it's really, really important as a value investor that you are doing your due diligence, that I'm doing my due diligence, that I'm doing my homework, because without that, we're going to struggle. Here's some other concepts that we need to think about as value investors. One is the inefficient market. And what we're looking for here is to try and determine what causes investment opportunities for value investors. Now, what is an inefficient market? So one theory is that as if the market is efficient, that means that it is always calculating the intrinsic value of a stock perfectly. I think that there are things in the stock market that can cause the price of a stock to get misaligned from its intrinsic value. That would be an inefficient market. So what causes this? Let's take a look. These are some sources of market inefficiency. We have emotions. There's fear or exuberance, and they can take over the market. There's sometimes a short-term focus from investors. They're looking for a quick gain. They're looking for a quick turnaround. Short-term issues or successes tend to be overly represented in the market price. If a company is doing very well in the short term, that can cause the price to go above its intrinsic value. If it does poorly in the short term, it can cause it to trade below its intrinsic value. Also, there's a herd mentality, and that's when investors tend to stampede to and from investments. Now, how as an investor should we approach the market? One of the things that we need to determine, and that I've determined, is that sometimes I am my worst enemy when it comes to investing. There are emotions and behaviors that we exhibit as human beings that cause us to make bad decisions at times. And so let's talk about some of those. These are behavioral finance and its impact on the value investor. How does the value investor combat their main nemesis? And who is their main nemesis? It's ourselves. There are cognitive biases. So first of all, we can become overconfident. We can over rely on predictions and neglect our proper due diligence. We can also experience anchoring. This is trusting in past data points, causing missed new information and failure to adapt. So for instance, if I buy a stock for $30 and it's trading at $50, emotionally, I want that stock to go back to $30 so I can buy more of it at $30 when it might actually be worth more than $50. So why not go ahead and buy more at 50 when it's actually worth more than 50? Another cognitive bias that we experience is confirmation. We're giving more weight to opinions that support our thesis, or even ignoring contrary evidence altogether. So we don't want to experience confirmation bias. There's also loss aversion. That loss aversion, it means that we have a higher sensitivity to future losses. We're more afraid of future losses than we are joyed by getting even bigger gains in the future. So there's a risk aversion, there's a loss aversion that we have. And so that sometimes that causes us to make bad decisions. And lastly, it's a herd mentality. We see trends, market bubbles, fear of missing out. There are things that we chase as investors. And sometimes we just need to back away from the cognitive biases and ask ourselves, do we have any of these? Am I overconfident? Am I anchoring? Am I facing confirmation bias? Am I looking at opinions that are going to be different from my own? Am I averse to loss? Or am I following the crowd? And sometimes following the crowd is not a great thing. In addition to cognitive biases, there are emotional biases. Emotional biases can be greed, so we're chasing high returns that result in bubbles, trends, or market overreactions. Sometimes it's fear. It drives panic selling at inopportune times. Sometimes we have regret aversion. We avoid making tough decisions because we might regret it. I've got a great example of this. I bought a couple of stocks a few years ago, and they just dropped, and they just kept dropping. And I believe in these companies. I think they're going to do well over time, but they just continue to drop. And so I had some regret aversion because I was expecting those stocks to come back over time, and I would regret selling it if they jumped back up, when really I just needed to move on. So regret aversion is real. I've experienced it myself, and if you're human, you've probably experienced it as well. And lastly, there's envy. We make irrational decisions driven by our desire to keep up with the success of others. So we want to be focused on our own portfolio with our own paradigm, with our own set of strategies for winning as an investor. So that gets us to the real point of the margin of safety. It really has to do with risk. What is risk and how does the value investor mitigate it? Here are sources of risk. There's business risk that can be operational risk, such as plant shutdowns, product recalls, management fraud, etc. There's financial risk that is poorly managed balance sheets, high debt levels, poor credit metrics. There is valuation risk where they may be paying more for assets like mergers and acquisitions than they are worth. There's liquidity risk where maybe their assets can't be sold timely or at a reasonable price to be able to source funds for operations. There's also market risk, and that market risk could lead to downward economic cycles and poor investor sentiment that really has very little to do with the company itself, but more about the market. So, what are risk management techniques that help us as investors? Here they are, and it starts with margin of safety. Margin of safety protects from incorrect investment thesis, from unforeseen events, and from changes in market conditions. So think about it this way. If a stock is worth $100 and I'm paying $80 for it, it gives me the ability to cover $20 worth of mistakes. Maybe the stock is really worth $80, right? So it gives me a bit of a cushion so that in case I've miscalculated the intrinsic value, the margin of safety gives me that cushion. Another risk management technique is diversification. Diversification protects from individual investment mistakes and reduces overall portfolio risk. I mean, if you think about it this way, if you just have one stock in your portfolio, your portfolio is going to move by the percentage of that stock. So it could turn out very good for you. It could turn out very bad for you. But at the end of the day, if you diversified into two stocks, then you're going to have probably half of the movement in the stock. So your volatility in your portfolio is going to go down a lot. So diversification is key to managing risk in your portfolio. The third is focusing on quality. Focusing on quality reduces the likelihood of permanent capital loss. So if you're buying a fly-by-night company who you don't know if they don't have a great balance sheet, they're a startup, you're going to have a higher risk that they don't make it than you would if you bought a solid company that's been around for a while, that's growing their business. Another is active portfolio management. Managing our portfolio provides opportunities to adjust our investments based on new information. Some people like to buy and hold. They just buy stocks and they just leave them in their portfolio. But I will tell you that every quarter has the potential for new information to come out. And if we are not staying up with that, if we're not assessing this new information, we may be keeping stocks much longer than we need to. I mean, I think about companies like 3M and Walgreens, Boots Alliance. If we're not looking at the information that comes out each quarter, then we run the risk of allowing that volatility into our portfolio. And then lastly is hedging. Hedging reduces downside exposure, but also reduces potential return. So you've probably heard of things like hedge funds, and they're basically hedging against certain activities. And they do this by investing in leveraged products like options and futures and things like that. I do very little hedging. My focus is on the first four of these risk management techniques. Maybe someday, when I grow up, I will do more hedging. But for right now, I found that the first four of these are solid risk management techniques. I can get my head around them, I can understand them, and I don't run the risk of my hedging strategy actually causing more volatility for me. So this book has been very informational. I would highly recommend it if you want to read that. It's called Margin of Safety by Paul Jones. If you try to get the one that's originally written by Seth Klarman, you will find it's very expensive. It's out of print. It could be multiple thousands of dollars to get that book. So why don't you spend just a few dollars and get the summary done by Paul Jones? It was very meaningful. Hopefully this video has been helpful for you. If you like content like this and you want to support this channel, in the comments to this video, you will find a Buy Me a Coffee link, and you can go there and support this channel. Also, if you'd like to learn more about dividend stock investing, consider subscribing to my Discord channel. It's free to join. The link is in the comments below. I'd love to have you there. We are a group of people, we're somewhere around 100 of us who are out there talking about stocks and enjoying the process. I consider this a community of people. And so if you want to join that community, we'd love to have you there. And if you want to watch more content like this, consider subscribing to the channel. I'd love to have you along for the journey. And with that, I'm going to get out of your hair, and I will see you on the next video.